Hi, my name's Adam. Welcome to the channel. Thanks for joining us in week 2 of building wealth through investing. So last week we went through different investment choices, whether it was kind of safe, mainstream, or alternative. Today we're going to focus on one of the primary ways to build wealth in Canada, which is through an RRSP. If you haven't already subscribed to the channel, make sure to subscribe and hit the notification bell. We release a new video every Tuesday and Friday, so twice a week, new content going out on how to build wealth, retire better, invest better, everything to do with your financial retirement and estate plan. So make sure to subscribe. Many of you that are watching these videos are not subscribers. So join our channel, become part of the family, and get more content on a weekly basis. So before we jump into the benefits of investing in an RSP, I want to go through what an RSP is because there's a lot of misinformation in Canada and a lot of people we come across don't understand an RSP. So an RSP is not an investment. An RSP is a special holding where you can put the investment. So it's basically like, look at it either as an umbrella or kind of a bucket where the investment goes. So an RSP is one type of bucket, a TFSA is one, a non-registered, but an RSP is a bucket. It's not the investment itself. So an RRSP is registered with the Canadian government and provides 2 key benefits that other accounts don't give you. Number 1 is that money contributed to an RSP is tax deductible against your income for that year. Number 2 is that money invested in an RSP grows tax deferred. So like a TFSA, which we'll cover next week, but an RSP, when you invest money in there, it grows tax deferred. So let's break down both benefits that the RSP gives you. So the tax deduction. So let's say you fall into a 35% tax bracket, which means that every dollar you earn, 35 cents goes to the government. So if you put $1,000 into an RSP, it's going to give you a tax break of $350. It's going to save you $350 of taxes that you would have paid otherwise, okay? So the way this works is if you made, $60,000 last year and you put in $1,000 to RSP, the government looks at it as if you only made $59,000. So it reduces your taxable income. So again, the amount that you get back, your tax deduction, is going to depend on what tax bracket you fall in. But at the end of the day, no matter what tax bracket you fall in, a tax deduction is a great way to put more money back in your pocket, which flows into the second benefit, which is tax deferred. So when you put money into an RSP, that money will grow tax deferred. What tax deferred means is that when you put, let's say, your $1,000 in and it earns some income, okay? That income, whether it's capital gains, dividends, or interest, is reinvested within the RSP and there's no tax due up front. So as you earn interest, capital gains, a dividend within that account, it's reinvested and that money grows. So you start compounding that deferred income, which again, you start compounding larger amounts of money, which is more benefit long-term to you. Now with an RSP, as that money grows tax deferred, down the road when you retire, you're gonna pull that money out. When you pull it out, it is taxable to you. But in general, and what we see with 99% of our clients is your tax bracket in retirement is lower than when you put the money in. So again, you put that $1,000 in at maybe a 35% tax bracket, but now you're pulling it out at a 20% tax bracket because you have lower income in retirement. So not only has the money grown tax deferred over time, which is a huge tax benefit, but when you pull it out, you're paying less tax than when you put it in. So again, there's some benefits there. There's also potential income splitting on that money as well. So there's a lot of benefits when you pull it out and you're going to be paying less tax. But again, you get the tax break or the tax deduction up front and you get tax deferred growth over time. So in some previous videos that we've put out there, we've always said $50,000 of income is roughly the threshold of if you should invest in an RSP or not, and maybe use the TFSA instead. So, and we stand behind that. We, in general, if you make under $50,000, you fall into a tax bracket that's gonna be pretty close to your tax bracket in retirement. So, you get the tax deferred growth, which is a great benefit, but you kind of lose the tax benefit of getting more of a tax break now, paying less in retirement. So just make sure you talk to your financial planner or tax advisor on if an RSP makes sense for you. But the tax deferment is a great benefit. And again, if you're in a higher tax bracket now than in retirement, that's another huge benefit that puts more money back in your pocket. So I want to quickly go through 3 ways to maximize your RRSP. So we now know that an RRSP is a great tool to use to save for retirement. In fact, it should be the #1 tool that you use to build up your retirement assets. The tax breaks up front and the tax deferred growth over time is unparalleled. So make sure to use your RRSP and make sure to use your RRSP room. We find that a lot of people enter into retirement with unused RRSP contribution room, and I get it. Early on, it's hard to use 18%. So you can contribute up to 18% of your income. There's maximums every year, which we've gone through in a previous video, which we'll link to up above here. But make sure that you go to maximize and use as much contribution room as you can over the years. Later in life, maybe once your mortgage is paid down, you're able to free up a bit more cash flow. Really top up that RRSP, take advantage of the tax breaks on that. Try to get to retirement with 0 contribution room. That is the ideal situation. But again, we know that that's not possible for all Canadians. So the first way to maximize your RRSP is just to start early. Start putting money in as early as possible. So to give you an example on the benefit of starting early, if you put $500 a month into an RRSP starting at age 30, when you retire at 65, you'll have about $668,000 if you earn 6%. Okay? If you don't start until age 40, so you delay 10 years and start putting money in at age 40, to get that same $668,000, you need to invest double the amount, $1,000 a month. So if you start at 30, it's $500 a month. If you start at 40, it's $1,000 a month. So just that 10 years makes a huge difference on how much money you're gonna have at retirement. So starting early, again, compound growth starts to work for you, and you don't have to invest maybe as much on a monthly basis long term to get the desired amount that you need to meet your retirement goals. The second way to maximize your RRSP is invest for the long term, okay? Most of us invest in RRSP unless you're putting money in your 60s and you look to retire in a few years. Maybe you need to adjust the risk profile there, but in general, as you're putting money into an RRSP, that money is for long-term growth. And remember, when you retire, whether it's 60, 65 or later, when you retire isn't the day that you're pulling all your money out of your RRSP. You're still letting it compound and grow over time. So make sure that your risk profile, your time horizon kind of matches, but you need to make sure that you're focusing on long-term and not getting scared off by short-term market fluctuation. So make sure to talk to your financial planner or investment advisor to put a plan in place that fits for you, but have a long-term kind of goal and investment approach in mind so that you can take advantage of long-term growth of markets and really compound your money further. So if you're just throwing your money in an RRSP and then leaving it in cash or a high interest savings account, you're not really going to have long-term growth. In fact, inflation could actually decrease your spending power long-term. So have a long-term investment plan in place around your RRSP. And the third and last way to maximize your RRSP, and I mentioned it earlier, is to use all of your contribution room. So set a goal for yourself and maybe map it out to make sure that you get to retirement with 0 contribution room. And again, earlier on in life, it's going to be tough. You have mortgage, maybe kids, there's more bills to pay. It's hard to put 18% of your earned income into retirement savings. But maybe later in life when your mortgage is done, you can put some money into your RRSP, top it up, and get to that retirement age with 0 contribution room. That is the end goal. But again, get as close as you can. Most people don't get to retirement with 0 RRSP room, but if you can, you're gonna probably set yourself up for a better, more financially viable retirement. And remember with an RRSP that there is a contribution limit. So just make sure you check on the CRA website on your notice of assessment what your contribution limit is to make sure that you don't over contribute. So we did cover off a video a few weeks ago on you can contribute over $2,000 in a lifetime and not pay any penalties, but above that is 1% per month. So make sure you reach your contribution limit, but don't go over it by more than the $2,000 mark. And remember, your RRSP is not the investment. It's just a special holding account for your investment. So, a lot of people get confused by that. So it's a holding account where your investment goes. So the type of investment can vary within your RRSP. The RRSP is just a holding account. So think of it of an umbrella. What you want to put under that umbrella to kind of build your wealth and build your retirement plan long term. So that summarizes the benefits of investing in a tax-preferred RRSP or a tax-deferred RRSP or tax-sheltered RRSP. There's many ways to say it, but an RRSP will help you build your wealth, compound your wealth, defer some taxes for you. And it's just a great retirement tool to help you, put money aside long term and make sure you have enough money in retirement to kind of complement everything else you have going on, whether it's a pension plan, CPP, OAS, sale of business, whatever it is. But use your RRSP, try to maximize it, and I promise you, it will really help reduce the taxes now and also build a better retirement nest egg for down the road. So next week, we're going to look at another, special holding account. So again, not an investment account, but a holding account in the tax-free savings account. So much like an RSP, it's the type of account. You can put different investments in there. So we're going to go over that next week. So make sure you join us next Tuesday for that video. Thanks again for joining us. If you haven't already subscribed to the channel, make sure to do so. And please hit the thumbs up. It really does help get our videos out. We see it firsthand in our videos. The more likes we get, the more people see our videos, and the more content is getting out to Canadians to help them save for retirement, put more money back in their pocket, pay less tax, and reach retirement the way they need to reach it. So thanks again for joining us. Have a great week.